The year 2026 was supposed to be the year of the soft landing, but in the freezing winds of a Chicago January, the illusion finally shattered. Without warning, the FDIC moved in, the target, Metropolitan Capital Bank and Trust. It wasn't a global titan like JP Morgan or Goldman Sachs. It was a local pillar, a bank that served the community, the small business owner, and the neighborhood investor. Но его крах не был случайностью. Это был первый симптом чикагского паттерна, смертоносного сочетания токсичной коммерческой недвижимости, испаряющейся ликвидности и цифрового бегства капитала. As we stand in early 2026, the FDIC's problem bank list is glowing red. Your local bank might vanish before you even have the chance to pull your cash. Welcome to the great consolidation. Welcome to the Chicago bank pattern. To understand the 2026 crisis, we must perform an autopsy on Metropolitan Capital. This wasn't a bank that bet on crypto or exotic derivatives. Its sin was far more traditional. It believed in the American city. Metropolitan Capital was heavily exposed to commercial real estate, CRE. В мире после 2020 года офисное пространство превратилось в мертвую зону. К 2026 году сроки аренды большинства корпоративных гигантов истекли, и здания, служившие залогом по кредитам, потеряли до 60% своей стоимости. When the bank tried to sell these loans, there were no buyers. When they tried to call the loans, the developers walked away, handing back the keys to empty glass towers. Metropolitan Capital found itself holding billions in ghost assets, valuations that existed only on paper. In 2026, the Chicago pattern reveals that if your bank is built on the foundation of city concrete, that foundation is now quicksand, but there is a deeper layer. Metropolitan wasn't just a victim of remote work, it was a victim of the refinancing wall. Between 2023 and 2026, billions in debt matured. When these loans were originated, interest rates were at 3%. To renew them in 2026, the rate jumped to 8%. The math simply broke. The cash flow of the buildings couldn't cover the new interest, and the bank was forced to mark these loans as non-performing. This is the smell of a systemic rot. Why are small banks vanishing while the big banks report record profits? The answer is the liquidity vacuum. In 2026, money is no longer loyal. With the Federal Reserve holding interest rates at restrictive levels to fight persistent inflation, small banks are caught in a lethal pincer movement. To keep your deposits, they must pay you high interest, but their income is trapped in low-interest loans they made years ago. For every dollar you deposit, the bank is losing money. Meanwhile, the big five banks don't have to raise their rates. They have the implicit guarantee. Everyone knows the government will save JP Morgan. No one knows if they will save the bank on your corner. This has created a bifurcated banking system. Capital is fleeing the risky small banks and hiding in the safe mega banks. In 2026, we are witnessing the largest migration of capital in history. It is a silent bank run. No one is standing in lines outside the doors. They are simply moving money via smartphone apps at 2 a.m. This silent run starves small banks of the deposits they need to function, forcing them to borrow from the Fed at even higher rates, accelerating their insolvency. In 2023, the world saw the Bank Term Funding Program, BTFP, save the system after Silicon Valley Bank. In 2026, the ghosts of that program have returned. The Fed introduced a temporary facility that allows banks to borrow against their devalued government bonds at par value. This means a bond worth 70 cents is treated as if it's worth 100 cents. This is accounting alchemy. However, this program is a double-edged sword. It keeps the bank's doors open, but it doesn't solve the underlying insolvency. It only delays the inevitable. Metropolitan Capital had exhausted its borrowing capacity from these federal facilities. When the Fed realized the collateral, the empty Chicago offices, was fundamentally worthless, they pulled the plug. In 2026, the presence of these rescue programs actually acts as a warning sign. If your bank is heavily reliant on the Fed's discount window or temporary funding facilities, it is already a zombie bank. It is dead, but it hasn't stopped moving yet. The Chicago pattern shows us that the Fed will only sustain the zombies until the great consolidation is ready to absorb them. We must look closer at the maturity wall. By 2026, nearly $2 trillion in commercial real estate loans have come due. Small and regional banks hold 70% of this exposure. This is not just an office problem. It has spread to multifamily housing and retail strip malls. As the interest rates stayed high, the capitalization rates, expanded. A building that was worth $100 million in 2021 is now appraised at $45 million. But the loan on that building is $70 million. The owner is underwater. In 2026, we are seeing a wave of jingle mail, where developers simply mail the keys to the bank. But a bank is not a real estate company. It doesn't know how to manage a 40-story office building. It certainly doesn't know how to sell it in a market where there are no buyers. Every building handed back to a small bank is a nail in its coffin. The Chicago bank pattern is the sound of thousands of keys hitting mahogany desks across America. The FDIC is the shield of the American depositor, but even a shield has a breaking point. In 2026, the FDIC's Deposit Insurance Fund, DIF, is under extreme duress. The problem bank list, a confidential internal list, has surged to its highest levels since the 2008 GFC. But there is a secondary danger, unrealized losses. Because interest rates rose so fast, the safe government bonds held by these banks have plummeted in value. If a bank is forced to sell those bonds to cover a withdrawal, they realize a massive loss. This creates a digital bank run. In 1930, you had to stand in line at the door. In 2026, you can move $10 million with a thumbprint. The speed of a bank run is now faster than the speed of light. By the time the regulators arrive on Monday morning, the bank is already a hollow shell. Metropolitan Capital was the warning shot. The rest of the list is a countdown. If the FDIC has to resolve 50 banks in a single quarter, the administrative delays could mean your insured money is trapped in a bureaucratic void for months. Beyond the regulated banks lies the shadow banking system, private equity firms, hedge funds, and non-bank lenders. In 2026, these entities are deeply intertwined with regional banks. Regional banks often provide warehouse lines of credit to these shadow lenders. When the shadow lenders face defaults on their own high-risk portfolios, they draw down their lines of credit from the banks. This creates a contagion loop. Metropolitan Capital was connected to several private credit funds that specialized in bridge loans for Chicago developers. When the developers defaulted, the private funds collapsed, taking their credit lines with them and draining Metropolitan's remaining liquidity. This is the dark web of finance. You think your bank is safe because it's regulated, but its balance sheet is a graveyard of unregulated risks. The Chicago pattern is not just about banks, It is about the collapse of the entire private credit ecosystem. The death of small banks isn't just a problem for depositors, it's a death sentence for the small business economy. Small banks are the lifeblood of local credit. They lend based on relationships, on handshakes, and on community knowledge. In 2026, we are witnessing financial desertification. As small banks vanish, credit becomes a luxury reserved only for the corporate giants. Megabanks don't care about the local dry cleaner or the family farm. Their algorithms find them too risky or not profitable enough. Without local banks, the American Main Street dies. The wealth of the community is no longer reinvested in the community. It is extracted and sent to Wall Street to fund stock buybacks and global derivatives. This is the great consolidation in action. You aren't losing a bank, you are losing your community's financial sovereignty. The Chicago pattern is the blueprint for a nation where only the giants are allowed to breathe. There is a term you must understand in 2026, the bail-in. Since the 2008 crisis, global regulators have moved away from taxpayer bailouts. The new framework focuses on bail-ins, where the bank's own creditors and large depositors are forced to take a loss to save the institution. While the FDIC protects the first $250,000, anyone with more than that is legally an unsecured creditor. In the collapse of Metropolitan Capital, many local businesses found their operating capital frozen as they were converted into equity in a dead bank. In 2026, your bank deposit is not a safe box. It is a loan you have made to the bank, and if the bank cannot pay its other debts, you are the one who takes the haircut. The Chicago pattern reminds us that in the age of consolidation, your deposit is the bank's last line of defense. You are the shield, not the FDIC. We have now reached stage 8 of the wealth timeline, the institutional vacuum. This is the phase where the middleman of finance, the regional bank, is eliminated. The government and the megabanks are becoming a single, monolithic entity. This is the necessary precursor to the central bank digital currency, CBDC. If the small banks vanish, the Fed doesn't need to work through them anymore. They can provide digital dollars directly to you, controlled and monitored from a central server. The Chicago bank pattern is the clear-cutting of the financial forest to make room for this new architecture. The death of Metropolitan Capital was not an accident. It was an evolutionary step toward a system of total financial control. The small bank is a relic of an owner society that is being dismantled to make way for a subscription society where even your access to your own money is a service you lease from the state. There is a psychological war happening in 2026. The media and the regulators use words like resilient, stable, and isolated to describe bank failures. They want you to stay calm while the floor is being pulled out from under you. This is manufacturing consent for consolidation. By making small banks appear risky and large banks appear safe, the government is nudging you to move your money into the giants voluntarily. They are destroying the competition without firing a single shot or passing a single law. In Chicago, the fall of Metropolitan caused a wave of fear that led depositors in 5 other local banks to move their money to Chase and Bank of America within 48 hours. This is the self-fulfilling prophecy of the Chicago pattern. Fear creates the run, and the run justifies the consolidation. How do you know if your bank is the next domino? In 2026, you must become your own analyst. Look at 3 key metrics: the CRE concentration ratio. If a bank's commercial real estate loans exceed 300% of its total capital, it is in the danger zone. Unrealized losses on securities, check the bank's available for sale, AFS, and held to maturity, HTM portfolios. If the losses there exceed their equity, the bank is technically insolvent. Deposit beta. How much is the bank paying for deposits? If they are paying 5% while their loan portfolio only earns 4%, they are bleeding out. Metropolitan Capital failed all three of these tests 6 months before the FDIC arrived. The information was public, but most people were too busy looking at the all-time highs of the S&P 500 to notice. In 2026, the truth is hidden in plain sight, buried in the quarterly call reports. The Chicago bank pattern is not just an American phenomenon. In 2026, we see similar patterns in Germany, the UK, and China. This is a global deleveraging event. The era of easy money, 2009 to 2021, created a global bubble in assets that were only viable at 0% interest rates. As those rates hit 5% and stayed there, the global financial architecture began to crack. Chicago is simply the epicenter of the American tremor. This synchronized collapse means there is no place to hide in traditional fiat banking. When the dominoes fall in Chicago, they rattle the windows in Frankfurt and Tokyo. We are moving toward a new Bretton Woods, a total reset of the financial system. But before the reset, there must be a great clearing. The small banks are the brushwood being burned to make room for the New World Order. The Chicago bank pattern is moving from the freezing streets of the Midwest to the sun-drenched offices of the South. The symptoms are identical: falling property values, evaporating liquidity, and a silent digital flight to the too big to fail titans. Do not wait for the police tape to appear across the glass doors of your local branch. Do not wait for the official announcement that everything is fine. Understand that in 2026, local often means vulnerable. The first domino has fallen in Chicago, the rest are already leaning. In the age of consolidation, your liquidity is your only true shield. The era of trusting the institution is over. The era of verifying the math has begun. Act accordingly.